Welcome back to the Value Add Multifamily Apartment Acquisition Underwriting series. In this episode, we're diving into one of the most powerful and profitable strategies in real estate investing, the value add deal. If you've ever wondered how investors take an average apartment building and turn it into a high performing asset, boosting income, increasing value, and generating strong returns, this is where it all begins. Understanding value add deals is the foundation of successful multifamily investing. Let's start with where the value add strategy fits among the main types of multifamily investment strategies. On one end of the spectrum, you have core and core plus investments. These are newer or recently renovated properties located in prime markets. Think Class A assets in strong high demand areas. They are typically stabilized with high occupancy, professional management, and predictable cash flow. For investors, these assets are about preserving capital and earning steady, low risk returns, not necessarily about forcing appreciation. On the opposite end, you'll find opportunistic investments. These are high risk, high reward projects, like ground up developments, full repositionings, or distressed properties that require major capital and operational restructuring. They offer the potential for big gains, but the execution risk is much higher and the returns take longer to realize. Right in the middle sits the value add strategy, the sweet spot for many investors. It offers a balanced approach, moderate risk, but with the opportunity to significantly increase value through hands on management and strategic improvements. In a value add deal, the property is already built, cash flowing, and occupied, but it is not operating at its full potential. Maybe rents are below market, the units are outdated, or expenses are higher than they should be. By making targeted upgrades, improving operations, and optimizing the capital structure, you can unlock that written value and generate returns well above what a stabilized property would offer. That's what makes the value add strategy so appealing. It's about creating value, not just waiting for the market to deliver it. A value add multifamily apartment acquisition is one of the most common and profitable investment strategies in commercial real estate. In today's commercial real estate market, value add investments represent one of the largest and most competitive strategies. They account for roughly one third of all deal activity and capture much of the capital targeting multifamily assets. These figures are estimates derived from institutional investment data and deal volume trends. They are approximate and may vary based on time period, location, investor profile, and asset quality. In commercial real estate, capital allocation is largely concentrated in value add and core plus strategies, with multifamily properties capturing the largest share of investment due to their strong income stability, renovation potential, and sustained housing demand. So, what is a value add multifamily deal? A value add multifamily deal is a property that has strong fundamentals, location, demand, and structure, but is not achieving its full income potential. Key aspects in a multifamily deal are location. The property sits in a desirable or improving area with good access to jobs, transportation, and amenities. Demand. There is consistent rental demand from tenants in that market. Structure. The building's physical framework is sound. solid concrete or steel construction, good bones, functional layout, and no major structural issues or unsafe systems. In commercial real estate, properties are commonly grouped into classes A, B, C, and D based on two main factors: location quality and building conditions. This classification system helps investors, lenders, and developers quickly evaluate a property's relative position in the market along with its risk and return profile. Class A properties represent the highest quality assets. Newer buildings located in prime areas with strong demographics, modern design, and premium amenities. Class B properties are typically older but well maintained, situated in solid neighborhoods with stable demand, and often present opportunities for value add improvements through renovation or operational upgrades. Class C properties, on the other hand, are usually older buildings in less desirable or emerging areas, often requiring significant capital investments to improve performance. Class D properties are the lowest tier, typically in highly challenged locations with weak demographics and high vacancy risk, often needing extensive capital improvement or repositioning to become viable. Understanding how each property class relates to location and condition is essential for determining pricing, financing terms, and investment strategies across the multifamily and broader commercial real estate landscape. Value add opportunities often come from Class B or Class C properties, well located buildings that might be a little outdated or undermanaged. They have good bones, strong market fundamentals, but plenty of room for improvement. In essence, in a value add multifamily deal, you acquire an underperforming property at a price below its potential market value. Through targeted renovations and improved management, you enhance operations and increase the property's net operating income. This higher income supports a graded asset valuation, allowing you to sell or refinance the property at a premium, typically reflected in a lower market cap rate. A typical value add deal has four things in common: physical conditions. The building may be a bit dated or in need of renovations. From outdated interiors in common areas to exterior upgrades. These physical improvements create immediate and tangible values. Operational inefficiencies. Many properties aren't managed as efficiently as they could be. Expenses might be higher than necessary, maintenance processes outdated, or management underperforming. Streamlining operations can significantly boost properties' profitability. Tenant profile. Often, value add properties have tenants paying below market rents, or the lease structure may not fully align with the property's potential. By improving the property and targeting the right tenant mix, you can increase income while maintaining strong occupancy. Financial performance. Finally, a value add property is underperforming relative to its market potential. The current net operating income is below what could be achieved after renovations, rent adjustments, and operational improvements. Identifying these gaps is where the real opportunity lies. Every value add deal starts with a detailed business plan. That includes capital improvements, renovating units, modernizing common areas, improving curb appeal. Rent increases, aligned with market comps and renovation quality. Expense optimization, reducing inefficiencies through better management and contracts. Financing structure, balancing debt and equity to maximize returns while managing risk. Exit strategy, planning for a profitable sale or refinance cash out once the property reaches stabilized income and market value. Now, let's take a deep dive into a detailed business plan, renovation, and capital improvement strategy. Allocate $10,000 per unit for interior upgrades to support a targeted rent increase of $200 per month. Renovated units should deliver tangible value enhancements, such as contemporary finishes, new appliances, or improved community amenities that strengthen the property's competitive positioning in the submarket. Rent increase assumptions. Rent growth should be grounded in thorough market comparables and aligned with the extent and quality of renovations performed. Any rent premiums must reflect the performance of similarly upgraded properties in the local market, ensuring that price is both realistic and sustainable to support tenant retention and maintain strong leasing velocity. Expense optimization. Enhance property operations by identifying and eliminating inefficiencies. Well executed optimization strategies can typically reduce total operating expenses by 5 to 15%, boosting net operating income and increasing overall property value. Financing structure. These projects are typically financed with a bridge loan or value add agency loan that includes renovation funding. The loan to cost ratio usually ranges from 70 to 75%, with an interest only period of 2 to 3 years during renovation. The remaining 25 to 30% of the capital stack is typically funded by investors or a syndicate. Exit strategy. After executing the business plan, the property will be sold and the loan fully repaid. Net proceeds from sale, after closing costs, will be distributed to investors, typically generating substantial returns driven by higher NOI and overall property appreciation. Target profit metrics for investors. Financial performance expectations vary based on market conditions, risk profile, and execution quality. For a well executed 5-year value add investment, typical target returns include a 6 to 10% cash on cash after stabilization, a 13% to 18% IRR in core markets, and a 17% to 22% IRR in secondary markets, and an equity multiple between 1.8 and 2.3 over 5 years. Here's a snapshot of a simplified 100 unit value add deal. The property is acquired for $15 million with a $2 million renovation budget, bringing the total project cost to $17 million. Financing includes a 70% loan to cost, or about $11.9 million in debt, and a $5.1 million in equity. The current NOI is $900,000, projected to grow to $1.5 million after renovations, an increase of $600,000. At an exit cap rate of 5.5%, the property's estimated value reaches $27.3 million. After repaying the loan and closing costs, investor equity at sale is roughly 10.5 million, delivering an equity multiple of 2.05x and an IRR between 17% and 18% over 5 years, with an average cash on cash return of 7% to 9%. So, that's the foundation of a value add multifamily deal: identifying opportunity, executing a smart plan, and creating long term value. If you want to dive deeper into underwriting and deal analysis, visit www.blueprintcre.com for more resources and our full training courses. And don't forget to like, subscribe, and hit the bell so you don't miss the next chapter in this series.